2023, the global private equity industry was hammered by rising interest rates. Borrowing costs jumped by 525 basis points from March 2022 to July 2023, the sharpest monetary tightening in decades. In response, the number of investments, exits, and buyout fund closes all extended a downward slide that had begun in 2021. Buyout deal value around the world has tumbled by 60% over 2 years, falling to $448 billion in the steepest drop since the global financial crisis. Against 2021, deal count was down 35%. Exits value declined by two-thirds, 66%, whilst the number of funds closed dropped by 55%. In investments, excluding add-ons, buyout investment value dropped to $438 billion, a 37% decrease from 2022, and the world's total since 2016. Overall, deal count dropped 20% to around 2,500 transactions. The steep slope of the decline was something the industry hadn't experienced since the global financial crisis. The malaise infected regions across the world, with Europe and Asia Pacific both experiencing significant declines.
In response to this challenging environment, leading GPs are really thinking about how to adapt their buy and build strategy, harness the power of Gen AI alongside the investment cycle, and really find creative solutions to generate liquidity for their investors, including secondaries or continuation vehicle. With market encouraging multiple arbitrage, buy and build has historically become one of the most popular strategies. But higher interest rates have disrupted this historically virtuous cycle of being bigger, being better. Meaning that GPs now need to really think about how to generate synergies in their buy and build strategies with clear top and bottom line benefits from their plays. As in every other industry, generative AI is changing the game for private equity, with implications at every level of the value chain. Industry leaders are already using this technology to scan portfolios, rethink due diligence, and investigate how they can improve decision-making and boost the return. Like any technology, we believe that generative AI is best deployed as a tool in service of strategy, both for the funds and their portfolio companies. It doesn't create value by itself, but by linking it explicitly to pragmatic business objectives and value. Another implication of the liquidity crunch is that secondary funds grew faster than any other asset class in 2023, raising 92% more capital, even if from a low base. They offer GPs and LPs tools to manage their own liquidity needs and those of their stakeholders. And while secondaries remain tiny compared to the rest of the industry, there's every reason to believe they will find a way to scale. We think that sectors that have been strong will continue to be strong in the future. Most notable, manufacturing and healthcare will continue to be driving forces within the industry. But we also see new areas developing as well. For example, we see a clear increase in investments around the energy transition value chain.
The speed of the interest rate increases in 2023 and the uncertainty it caused have had a direct impact on the private equity industry. However, this year we're seeing a better start, and our forecasts indicate a clear trend towards moderation in interest rates in the coming months. So we remain cautiously optimistic. Thanks to the incentives to use the unprecedented trade power reserves, we expect private equity firms to react.